The following is a presentation of TFNN. It is now time for the Diagnostic Trading Hour with your host, Darrell Martin. Now, Darrell Martin.
All right, folks, welcome on here to the Diagnostic Trading Hour. And I'm your host, Darrell Martin, right here on TFNN. Don't forget you can listen to us on your mobile phone anywhere at tfnn.mobi. Let's check out where the markets are at right now. We got the S&P is up a whole point and a half fluctuating there. So not a lot going on. Had a little move up and then pulled on back on, just pretty flat and choppy right now. We have the NASDAQ down a couple points. We have the Russell down 3. The Dow's up 18. So it was pretty funny. I saw a news headline on CNN. It's like, Microsoft surges 17%. And then all of a sudden it looked, Dow's up 10 points. And I'm like, that's not a big number. But I mean, it was big red letters. Whole 10 points. But now it's up 19. We got gold right now. It's up a mere 3.9. We got silver. It's down about 0.75%. We got copper. It's up a little, but pretty flat on the day there. Oil is up 68 cents. And we got natural gas is up over 1% on the day. Corn is currently trading flat. And soybeans is down a couple points. Euro dollar literally up 2 ticks. Pound dollar down 36, Aussie dollar down 44, Euro yen up 24, US yen up 18, pound yen down 33, dollar CAD up 24, and dollar franc is up 10 pips on the day. So one of the things I want to go over, we talked about the volume spikes and how to trade the volume spikes, but one thing that a lot of traders don't know how to do is when they're doing Forex, when you look at volume on Forex, you're not really looking at volume. Right? What you're looking at is what's called tick volume. So how many times the price has changed inside that bar. And so, to give you an example right here. And so there's a couple ways that you can do this. Now, whether you're using Thinkorswim or using, say, NinjaTrader. If I'm using Thinkorswim, it's pretty simple. Okay, so let me show this to you. I'll pull up a Thinkorswim chart for you. It's like right over here. I literally just put the two charts side by side, and it links. You can see the bar goes with me there, and so on Thinkorswim I can see that right there, and I can see the volume on 6A, and I can see the price over here on the Aussie dollar. So say you're trading spot FX, and now I will want to keep in mind things like, obviously there is a different price between the futures and the Forex. The reason being is the carry trade or the swap, and that's the interest being paid out if you're, long the Aussie and borrowing the dollar or vice versa. And so, but if you ever want to figure out what that is, it's real simple. It's going to stay about the same most of the day. It may fluctuate by a few ticks, but you just go in and go, 95.79 minus 95.49. So it's basically a 30 pip difference, and that'll be pretty consistent for most of the day. You'll want to check that every day, but at least you can see the volume spikes over here on the futures if you're trading the spot FX. Now, what about if you're trading, on Ninja? So it's my preferred platform. If you go over to NinjaTrader here, and I'll pull up a chart, we'll look at that. And I'll go here, I'll go to data series, and what I do is I add another instrument. Okay? So, 6, B12-13. So I put that on there. And then what I'll do is I'll actually make the futures. Now, this is only if you're trading spot FX that you need to do this, but then I'll put the futures. And I'll go in and I'll make the bars, okay, transparent, like so. And what that'll do for me is it makes it where the bars don't show up, obviously, and then hit apply, okay. Now that I've done that, I'm going to go in here and I'll go to my indicators. And I'll change my volume. Instead of following the pound dollar spot, I simply choose it to follow the futures. Okay? And click right there, click apply. And you can get rid of this panel, you can shrink it down. But now what I'm actually able to see is the volume off of my futures chart while looking at the volume, actually looking at the spot Forex. and that way I can more easily identify a volume spike. Now, of course, if I would change the instrument, then it's not going to change for me, so I'd have to go over. So if I went over here and changed this, say, to Aussie dollar, either I need to have multiple charts opened up, or I'm going to have to go in and have to update my data series. So it's probably better you have multiple charts opened up, so that way you don't have to go in here and go 6A 12-13, click new. Again, you have to make it transparent. So, like I said, I recommend that you go in and have several charts, whatever instruments you like to follow, and then you have to go back in and do your indicator again, and then add the volume up down back onto it, because since you deleted the instrument that had it, you'll have to re-add it. So you just go down there, add volume, and then change it to match the instrument that you want right here on the side. So pretty simple little trick, but it allows you to get accurate volume readings on Forex markets. And so that's one of the ways to get around that issue of not having true volume. And so many traders will go in and they'll look at the the Forex spot volume, and sometimes there's a lot of similarity, but the bottom line, it's really just ticks. It's up and down ticks. So at least on most platforms. And even the platforms that may have it, if they do have it, it's probably going to be based upon their volume at best on that one, broker or that one platform. So, anyways, but looking at that helps you see any kind of potential volume spike. Like over here, we just had the Aussie dollar. It had, let's see, a volume of 300, a volume of, right there, not 300. Let's see here, down volume, up volume. So down volume 300, up volume, a couple of contracts there, and it'll let you. I'm trying to expand it out. There we go. Okay, up volume and down volume. It looks like it's messing up there a little bit, but we got an up volume of 628. We got a down volume about 300, and then we have another up volume there of 192. So the volume here is twice the size of the volume on both sides, and we're right at the -1 deviation level. So that can give you some confidence on doing, it's a couple confirmations on doing a deviation volume spike reversal trade off of that, going up, maybe targeting either the 0.7 like with an out of the money, or you could also be using this in order to maybe do an in the money contract below like 95.69. So that expires at, I was looking at one that was expiring at 1 o'clock as a potential trade for that. So, and there was one that it was right there at 95, I want to say it was 65. I don't have to find the contract I had up there. But there was a contract right below you could guide in. So that's one way to do the trade. So either it can be doing the out of the money or the in the monies. But those volume spikes are very helpful, and it's good to have them on Forex. It's also important to make sure you're noting at them at deviation levels. The most important time, of course, is at a 1 deviation level, or later in the lunch hour. They'll have more impact as well. Okay. So, anyways, hopefully that helps you out, and it's just a nice little trick you can use to give yourself an edge on spot Forex, something that most traders don't even think of. A lot of spot Forex traders using like MetaTrader 4, which is really, in my opinion, one of the worst platforms to use. But it's a platform that you can use. You go in, but you're not going to get volume. You're going to get tick volume, and the broker can see everything you're doing. So there's a lot of issues with MT4. But you can go here on Ninja Traders that you combine futures and Forex together, and you can basically use that edge to help you out. And notice if I go over here and I put on this one right here, and you'll see, we're getting this volume right here. So now I have a different kind of data feed that helps out. It gives me a little better picture. Still not a complete picture, but a little better picture, because I have like 12 different bank feeds coming in. But it's still not going to be the exact same as doing a true futures contract for volume analysis. Anyways, let's go ahead. Let's check out where the markets are at right now, and we'll also go ahead and look at some of the moves that are happening. So we just had that spike reversal happening there off the Aussie. See, this moved up, hit the 0.7, so it would have been a beautiful trade right there. And let's look at the pound. So the pound, we had a news announcement come out last night, but we had some interesting things that went on with that. And I hopped on right around 11 o'clock, and it was honestly just too expensive. So it was outside the maximum risk, and maximum means maximum. So it was definitely outside that maximum risk on the trade. And so I couldn't justify getting into it. I'm like, wow. I mean, usually like that maximum is more than enough. And, of course, as you know, I love doing the straddles. I'll do the strangles now and then, but it's pretty rare. It's more like on the NASDAQ, plays and stuff like that. And so anyway, so went in and looked at it. We can do a little review, a step-by-step walkthrough on it. But I was looking for about a $45 risk, and it was about 46 to 48. And I know that sounds like, well, that's only $1. Yeah, but I don't want to go any greater than 45. That's really like the most I would want to be looking at if doing these trades. And the market shortly after 11, was glad we didn't hop in on the market shortly after 11. It popped up and took off up there, and had a nice move, about a 40 pip move. But you're paying like 25, 30 pips just for that one contract. Okay? So when it went up there, it was up maybe like $15. And so you weren't up that much on that when you bought. The one you sold, you were down, 25 or whatever. It came back down, it oscillated. And there were, I saw some traders do some, interesting, layering in trades and things like that. But basically the spreads that they were looking at were the 5,900 to 62. So if we look at that, you can just sort of see the issue here. But again, 59. Am I reading that right? 1.59 to 1.62. Yeah, okay. So let's bring that down here even further. It's massive. And right there. There we go. So they started at 11 o'clock. And they went. Hit the wrong button there. Started at 11 o'clock right over here. And they went all the way until 7 a.m. Okay? And then they also, so they sold that one, the ones that did hop in on this one, and they bought the one above it. Okay? And the one above it was the, 6,200 to 65. So it went way up here. And again, that one also started at 11 and went to 7 a.m. So put that one on there. That's what's called a straddle. It's where basically you're buying and selling. You're buying the spread above the market, has capped risk. So if it hits max loss, the other one can make more than that if it goes far enough, or vice versa. The one you sold will stop losing money above the ceiling of the spread, the top here, and therefore it has capped risk. Sort of, it's the same thing as like buying a call and a put. A lot of similarities to that, but it moves a lot faster because you don't have massive time premium weighing you down like you do on a call and a put with lower thetas and lower deltas and gammas and everything else because they expire the same day. And so we go in here, you look at this, and these are priced around maybe the best trade on was I'm guessing $50 or so. You might have got a little bit better, but again, that was above the max risk, so that's why we definitely adhere to that max risk. But then it popped up here and hit this deviation level. And of course, if you're doing this at night, you wouldn't have even probably noticed because you're probably in bed or whatever. But then it flew on back down, and when the news came out, it came in right at expectations. So we'll talk a little bit about what to do when this happens. All right, stay right there. We'll be back right after this break.
Who says you can't take it with you? TFNN says you can. With your mobile device and TFNN's live radio streams, TFNN has put it all in the palm of your hands. No special apps to download. No subscription fees for live radio or Tiger TV streams. We say you can.
Now let's go over to the dollar, because the dollar is going to be the generator. It is the generator of basically higher dollar, lower market. And what the dollar has done, and this whole uptrend, folks, has just gone sideways. The way it works, folks, is this.
We say you can. The Tiger Financial News Network. Smart investors and professional traders know you can. TFNN.com. Educating investors. with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, David White, Larry Pezzamento, Andy Hecht, Victor Jones, or Darrell Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Patterns, profits, and peace of mind.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pezzavento's trading newsletter.
Patterns, profits, and peace of mind.
In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the Forex market, and more. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 full weeks. That's an $85 value. Yours free when you register right now.
Get Larry's Patterns, Profits, and Peace of Mind.
And get the edge you've been looking for.
Investors, Taz Market Research delivers to its subscribers expert commentary on the analysis of 15 different markets each day. Get this invaluable and timely information through the daily market research videos Taz Market Research produces each day before 9 a.m. The video analysis will include reports on currencies, interest rates, indices, metals, energies, grains, and more. You'll be able to gauge where high profitability setups are in each of the markets. Receive a free 2-week trial subscription to Taz Market Research videos on the front page of TFNN.com. Darrell takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044.
All right, folks, we're coming back here to the Diagnostics Trading Hour. So we're looking at the pound dollar, and there's several ways to do this trade. You can do the early entry time frame where you're hopping in and deciding to get in there and enter like at 11 o'clock or whatever. And then you also could do the one that's like 15 minutes before it comes out. So if we look at this, what we're seeing over here is if you went in 15 minutes before. Now, I don't get up this early in the morning. You might, not my big cup of tea, but right over here, what we can see is the announcement comes out at 4:30, and it came in right at expectations. Okay? So again, right at expectations. And let's look at that. We'll go in maybe even a little bit tighter there to 5 minutes, so we can see it a little cleaner. And so right over here, we see this, and you can see the volume spike comes out, and then just pop. All right, flies on up there, and at expectations, it's one of the best pound reports that's come out like in the last year or so for their preliminary GDP. Usually a big mover, and would expect this one to be a big mover. The issue on this one, the reason we didn't have a big move on it, was because the report again came in at expectations. They expected 0.8 came in. Often these numbers are not at expectations, and so you're able to go in and profit on the massive move that takes place. So if we look at this right here, if you would have got in at this time, right over here, then the would have went down the low within 2 hours, 7 o'clock there, would have been 19 pips. So not really a big move. And then here, the high would have been 38 pips. So what I do want you to notice is if you would have got in later, and again, I don't do this. I don't get in like at 4:15 in the morning because I'm asleep. But if you would have got in, when you saw that pound dollar number came out on as expectations, right there, when it came out right there out the number, that's your clue to go for break even. Okay? And so you could have got out of that trade at that time. Obviously, it would have been a little cheaper, quite a bit cheaper, and you could have exited the trade at break even. So that's the first thing I want you to see. Just normally, during the day, how a lot of times we're entering these trades earlier. And so do that one right there, and then right here, go over on this, and then now let's look at what would happen if you got in earlier. Well, it moved quite a bit. So let's say you got in like right when it opened up. Okay? We got a high move up of about 49 pips. So a pretty big move. And then we got a low move, of 14. And the issue being, like, if you went in, you would have risked like $50 on this trade. You never would have had a chance to get out. You could have got it at break even, but the market moved up 50 pips. Why would you get out? You think it's going to keep going. You're waiting on the news announcement. News hasn't come out yet. So now what you could have done is you could have got out. You could have taken profit, and then as the other one came back down, you may have been profitable on that one. But that's if you're, managing it. So, anyways, the big lesson on this one is make sure, okay, that if there's not a trade there, that you don't take it. So again, if there's not a trade, if it's the risk is too high on the trade that's coming up, the potential trade, then you want to avoid that trade. Okay, so like when I say $45 max risk, like we really don't want to go higher than that, simply because you got to think about where my take profit's going to be. And even though it was only anywhere between $1 and $10 over that, I even feel nervous when I'm putting on the full 45. So it's just I obviously I want to be as conservative as possible. And some of these trades we've got in for like $30, $35, even earlier this week on the pound. So you can do those trades. Just make sure that you keep the risk in check. Do have your take profit orders in. If you were an early bird trader there, the trade could have worked out okay for you. Just depending upon what your risk was, probably estimating somewhere around $30 on the trade. And so as soon as you see that number comes in at expectations, if the thing flies up, it gives you about 5 minutes to figure it out, okay? And then it comes all the way back down. You would have given all that profit away. So you want to make sure that whenever those numbers do come in, that you're avoiding staying in a trade where there should really be no fundamental shock because the number comes in as reported. Let's see. What do we have coming up? Also, there was one other trade, and this was just sort of a random, and I said demo this one. I was very clear. I was like, demo this trade. And I'm trying to figure out a way to take advantage of this one. It might even be something of butterfly. But the consumer sentiment report. We'll talk about that one. And there has to be some way to take advantage of this, and it might be as simple as a butterfly. But we'll talk about it when we get back from this break.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's NADEX.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Wednesday, October 30th at 6:30 p.m., Andy Hecht has a special live online workshop for his subscribers to his weekly newsletter, the Technomental Commodity Report, called A Roadmap That All Investors Should Use, But Most Don't. During this hour-long live webinar, Andy will teach you how to use free and readily available market data to calculate the future expected price range for any asset. It's a simple yet powerful method that every investor should have in their toolbox. The best part is that you can attend this live online workshop, which will be archived, by simply signing up for a 30-day free trial to Andy's newsletter, the Technomental Commodity Report. And this is the last month to lock in the low introductory rate of only $39 a month. This price will be going up by over 25% come November, so now is the perfect time to get in on the action. Sign up for your 30-day free trial to the Technomental Commodity Report today by visiting the front page of TFNN.com. Darrell Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Darrell Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
This segment is brought to you by Think or Swim. For more information, just click the Think or Swim banner on the front page of TFNN.com.
All right, folks. Welcome on back here to the Diagnostic Trading Hour. All right, so we got market on moving, and we're just going through different ways that you can set these up, different ways you can do these trades. But the big thing is just getting that volume spike down, learning how to use it, and checking out where the market's at right now. So one of the things I was talking about was this University of Michigan Consumer Sentiment Report, and it comes out sort of at an odd time. It comes out at 9:55, and it's usually not a major impact report. And I've tried it several times doing strangles, demoing it, and it's really not working out that well because it really just is not moving at all. So looking right over here, and 9:55, right there. I mean, you can see no movement on the dollar yen. I mean, down 5 pips, up 5 pips. The trick on this, if it's going to work, and I mean, you're talking about literally risking $10 total, okay, is you'd be doing it consistently, and you'd be looking more for the profitability of it expiring and the money, because it comes out every month. All right? So if just one of them expires in the money out of 10, then you're break even. You make $90, and then you lose $10 on 9 trades. If 2 of them, you're actually starting to make money. 3 of them on down the list. Now, the other choice is you could butterfly. You could hop in right before this news announcement and put a butterfly on if you see some decent volatility in there. And you'd have to really use the intraday because you need the 10 o'clock expiration. And you would have to go in and obviously either if it's too expensive, that's when you're looking at a butterfly. If it's really cheap, that's when you're looking at a strangle. And usually it's going to be pretty cheap. It's on a Friday afternoon when the Aussie dollar is usually, or not Aussie, but I mean FX in general, is usually a lot quieter. And so just looking at this one right here, this morning it really wouldn't have done anything for you. Had a couple traders try it out on demo as well, and didn't see it really move. But it's one that I'm going to keep watching, because if you go back, like I said, it's 1 out of 10, and it's profitable on a very, very low risk. And you put the trade on literally like 5-10 minutes before. And if that number is greatly off, then that's where you're looking at potentially grabbing some profit on it. But it's just an experiment. I have some of these I experiment on, some I do regularly, and that one's one I'm just sort of playing with right now. And start looking at is different, based on what time a report comes out, is there a different way that you can take advantage of the contracts over on Nadex, is the idea. Okay, so if we go right over here, we can check out where the markets are at the moment, and then we'll also go into what news is coming up. We had the dollar-yen, and it moved up and on down, so about a 1 deviation move from high to low right there. So it's always important to make sure you're tracking that high to low on the deviation. Like if I go right here, settlement to 1 deviation, 53 ticks. If I go over here and I go, okay, well, what's the low and what's the high? So, and get that right there, about 54 ticks. So we're right there at a 1 deviation move before the dollar-yen started pulling back a little bit. Dollar getting a little bit weaker now. So it's been strong a good majority of the day. And so it may start pulling back. We'll see if this is consistent across the other currency pairs. We'll go in. Let's check out the Aussie. Saw it move on down, right down to 1 deviation. Start pulling on back up right now. Sitting right there at that 0.7. Trying to decide if it can really just bust through it or not. And we saw, sort of close right above it, but it's just hanging out right there. So we'll see if it can bust on through, but it's trying at the moment. And we did have a nice volume. We got to watch out for these little volume spikes and stuff like that. But so far we had a volume spike, but the price came lower and then went back up. So sort of invalidates the entire volume spike for you, because again, look, volume spike on an uptrend, but we don't expect the bar afterwards to go lower than the big volume spike bar that dropped down. And the bar after that has to go below it. Since none of those have happened, we'll see if that continues to be so. But it looks like Aussie dollar might keep moving on up. Dollar getting a little bit, giving up a little bit of that strength. Let's go in. Let's check out the euro dollar. And we can see the same thing. Euro's moving up. Dollar is getting weaker now after dollar getting stronger against the euro for a good chunk of the evening. Moving on from 0.5 and really didn't quite hit 0.5 on the downside. Not a full deviation move on the euro dollar. Very, very range bound today. And perfect butterfly market. And, I say that, people go, well, what do you mean butterfly market, perfect butterfly market? How does that work? Well, what you're doing is you're basically saying it's going to stay range bound. And, you can't ask for more range bound than what we're looking at right now, right? Just look at this. It's just right in this range. And so how do you make money, when paint's drying? You go in, you check out the binaries. And you can look up different contracts that are available. So let's see if we go in, we pull this up, we grab, say, the euro dollar as an example, okay? And then we'll throw in like a 65 to 95 and drag this thing out to this end of the day, see what all we got. And you can go down here and look right at the euro dollar. You can see, is there anything there that might be a decent trade or not? Now, it's very, very range bound, okay? So how do we take advantage of this? Well, the way that you could do that is you could say buy the 3800, sell the 3811 would be a way to do that. So let's look at what that would look like on a chart. And how would you manage that? Would you be comfortable with those strikes based upon the volatility where the market's been going? So I'll look at like the low over here. We got about 3790. So the market has moved lower than that, but not here in the last hour or so. 3800 would literally be just a matter of like 4 ticks away. So probably not a big fan on the 3800 one. The 3811 one is up about 8 ticks, but that's literally how narrow they see the market range right now. You can even see that in the price of the binary. The market range is very, very high probability. So, anyways, that's how you would do that. You would you'd buy the one above it, like the 3800. Sorry, buy the one below it, and which would be really close, so right here, and then you'd sell the one above it. Okay. 3811, like right there. Now, you can also let them fluctuate and do all that, but one of the cool things is if you do decide to get into it, if you're willing to get out as soon as it hits the strike, if you do decide to get in, And as it oscillates up, you can take profit. Okay? As it oscillates down, you can take profit. So if you bought this upper one for, say, $73, then if it moved up like, say, 2 or 3 ticks, you might be able to get out of the thing for literally, $90, $95 on the trade. If you sold the 38.11, the higher strike, then you may be able to, sell for, say, about, $18 right now. You may be able to buy it back for $5. And but it's just, there we go. Let's get the a little bit more perspective. And so really, you're just saying in between this range. That's all you're doing. And I want to show you actually how to put the entire thing on. So here, we'll just throw it in. Give me 1 second. I'll pull that up, and we'll throw it out. I'll throw in like a whole demo section here. We'll just put the entire thing together. So if we're doing this right here, we go in. So you can do demo or live. Okay. Whichever one you want to do, just to learn how to do. The big thing I want you to learn is how to do these. And you choose your market. You put 65 to 95. Make sure there's enough time to cover the potential contracts. And right here we got 38.11, a little bit higher than 38.07. There is one that's closer time to expiration, but it's obviously only a few ticks away on the upside. And then you'd sell the 38.11. So you click on that. Hit place order. Okay. Then you buy the 38 for 76. Okay. And now you have 2 choices, because we're bringing in actually a decent amount of income on these. We're bringing in about $44 on these trades, which would put you very close to a 1-to-1. Because if I sell the one above it for 21, and I sell the one below it for, or buy the one below it for 75, I'm basically, like I said, getting $44, which means I have about a $55 risk. So again, if I sell this one up here for $20, and I buy the one below it, let's see, what price did I get filled on that? Let's see here. I bought the one below it for 76. Okay? So right there, 76. And then you have the difference between the two, or the, I guess, which would be, you can make $20 on, not really difference, but you make $20 on the one that you sold, you make $24 on the one that you bought. Here's why. When I buy a binary, the price that I buy it for is my risk. My profit potential is $100 minus my risk. So if I buy it for 76, the most I can make is 24. If I sell a binary, the price I sell it for is my profit. So $100 minus my profit is my risk on a sell side. So I have a $44 profit potential on the trade. I cannot lose on both sides of the trade. Now, if I guess I could lose if it moved up and I got out of the short, and moved down, I got out of the long. But the only way that could happen is if you basically caused yourself to do it. Because at expiration, at 3 o'clock, the euro dollar cannot be both lower than 3,800 and higher than 38.11. It can be above it, it can be below it, it can be in between it, but it can't be both. So now that I have that set up and put that in there, and I go, what is my risk on the trade then? Let's say I did just hold the thing, because I'm close to a 1-to-1. Why am I close to 1-to-1? Because I can hold its expiration. Well, the way you're close to 1-to-1 is if I'm risking 76 on the one I bought, but I make 20 on the one I sold, I lose $56. If I'm risking $80 on the one I sold, but I make, let's see, $24 on the one I bought, then I make, I lost 56 net. So we're pretty close to 1-to-1. You could literally just hold this thing through to expiration, and your worst case would be $56 loss on a $44 profit. Now, as it moves up and down, you can also set take profit orders, so that way you don't have to hold it all the way till expiration. And the way that you would do that is, let's say we bought the lower one there for $76. You just go in here and you set a take profit, say up at 95. Hit place order. Okay? So now if it moves up a little bit, it'll close out that long contract for me. And then I can even set one on my when I'm selling. And over here, to take profit, let's just say at, buy it back at 5. I sold it at 20. So I'm saying, hey, buy it back if it gets down to $5 on that trade. And I can still hold these through to expiration, okay? Because if it's just oscillating up and down, I actually could end up getting both my profits filled on both sides, and I've eliminated the risk from the other side by doing it. Now, I also have decreased my profit by $5 by doing it, okay? Because obviously if I took off the profit early, I've lowered my profit on each side by $5. So that's the disadvantage. The advantage is if I'm able to close it before expiration, the sooner I can close the trade and take a profit, obviously the sooner I cannot lose on the trade. So I like to put my take profits in on these and just let either time or, small market fluctuations take advantage of it. Now, if I really want to take my risk down a whole nother notch, let's say if I bought this at 76, well, I could get out of it at about a $25 loss, okay? So, because I could buy it back if it hits the strike, like right around $50. And then I close the other one. If it hits that strike, the other one's probably worth, I'll probably basically have most of the profit. And say like 15 of the $20 profit. And so, subtract 15 from that, I basically could lose $10 on the trade if I did that versus, losing $55. So I could get out of the strike if it's hit in order to reduce my risk, my exposure on the trade. And what that would do is it basically make it where I have a $10, $10 to $15 risk on a $44 profit by choosing to exit when it hits it. So that increases my profit substantially. I mean, now you're talking, instead of close to 1-to-1, you're talking 400% return. However, it also decreases my probability, because if it touches the strike and it comes right back in, of course, I could have been profitable, and now I took a loss of $10 instead of a profit of $44. So, anyways, play with these, but all it is range bound. When you see flat markets, the indices, we were seeing those things not doing anything earlier today. When you see flat markets, Forex on Fridays especially, a lot of times even on Mondays, check out these range-bound butterfly trades at different times. You don't have to go in the day. I'm just throwing one example up there. Depends on what time you want to get in. And you don't have to go in 10 minutes before expiration. The further from expiration on the butterfly, the better, because it'll be wider. The one bad thing about doing it further from expiration, of course, is there's more time for the market to move. So, but the good thing is, if you can get it 20 pips wide, 30 pips wide, 40 pips wide, then, you have you've increased, the wider that thing is, the more you've increased your probability of it staying inside that range. And this is sort of like doing an iron condor. A lot of y'all have done iron condors before, iron albatrosses. But instead of having to wait a month or a week for it to expire, you can do it every hour. You can do it every couple hours. You can at least do it every day. Of course, you can do weekly, because I do have weekly contracts as well. But you also have defined risk, and it's not as, sounds sort of funny, it's not as risky as iron condors, because you go in on a lot of those, you go in and you're risking like $950 to make $50. So whereas I'm showing you how to do like 1-to-1s, or even like 4-to-1 reward to risk ratio. Whereas on an iron condor, if you do a small credit spread, that thing gets all the way to that strike and you get out, you're still going to lose. You may only lose like half the amount, but you're still going to lose quite a bit. And if implied volatility kicked in, you're going to lose even more. So this is a way to do those neutral strategies for those of you who don't like to pick direction and don't think the market's going anywhere. And you can do this on oil, gold, corn, soybeans, copper, silver. You can do it on all these major FX pairs. You can do it on the DAX, the FTSE, the Nikkei, obviously the S&P, the Dow, the Russell, and the NASDAQ. So you have a lot of choices, a lot of variety. And I know a lot of traders have come over from doing credit spreads to starting to do these, and they like them a lot more. Just because they don't have to wait so long. So anyways, stay there. We'll be right back after this break.
You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today. Basil Chapman has just announced that he will be hosting a one-day online master trader class. Friday, November 8th, Basil Chapman will teach you the essential fundamentals he uses when trading the market with his Chapman Wave methodology. Included in this full-day online master trader class is 1 month of Basil's daily newsletter service, The Opening Call, a $128 value, as well as a copy of his CD book introducing the Chapman Wave methodology, which usually sells for $249. Join Basil Chapman for this powerful one-day online master trader class Friday, November 8th, which will be archived if you can't attend live, where he'll give you a complete understanding of the Chapman Wave methodology and how to apply it to profitably trade any market in any time frame. For all the details and to reserve your spot while taking advantage of early bird pricing and saving $200 off the regular price, visit the front page of TFNN.com today.
Have you subscribed to the Gold Report yet? On Wednesday, August 14th and Thursday, August 15th, Tom O'Brien advised his Gold Report subscribers to close out 6 of their 9 open positions, all winning trades ranging from a 10.69% profit to an incredible 48% profit in just one equity. Tom O'Brien brings an incredible wealth of knowledge and experience to the gold market and the equities within the industry. That's almost 12 years since this powerful newsletter first began. And right now, you can get a 30-day free trial to the Gold Report by visiting TFNN.com. Make sure you're a subscriber as this volatile gold market makes its way back into positive territory after declining all the way from $1,900 to under $1,200 an ounce in only 2 years. Get your 30-day free trial today by visiting TFNN.com.
Join David White as he keeps you up to date on the latest tech stocks while he uses his Power Law Vector Indicator to identify the best trades. The Power Trading Hour, next on TFNN.
All right, folks, welcome back here to the Diagnostic Trading Hour. So just doing a quick roundup. Let's check out where everything's at right now. We went through the currency pairs. Go ahead and look at oil. Oil right now moving on up, sitting right around the half deviation mark, coming into its close here in about half an hour, and at least on the floor there. And going in, checking out the S&P. We got the S&P right now is basically just flat on the day, doing a whole lot of nothing. We got gold, and gold's had a little bit of a decent move, moved on down, and running on back up. Basically a one deviation move from low to high that it just came off of. And if you look at that, if you'll measure that, you could have caught that deviation spike reversal trade. I went short on that one there. But I mean, go over here and you can see, again, the low to the high right there, and about 20 points. And then if we go here, we can check out what is a deviation. A little less than 20 points. So I went in, it spiked right into that, took it a minute, came on back down, and went just flat right after it broke it. But we got a volume spike at a 1 deviation move, which is what we love to look for on these trades. So just like we had one this morning. Look at that right there. Came down, boom, pops up. All right, so what else we got? Let's go ahead and check out copper. And copper is a pretty fun one to play as well. Can have some good moves on it. And some good volume spike reversals and things going on. But we got about a deviation move on that one. Not as many copper traders out there, I know. And but it can be pretty intense if you trade the futures, because, man, those things, they got a pretty high value. Sort of like silver there. Silver, it's ran down, massive rundown. Look at this. Check this out. We got to move on down to 2 deviations. And then it makes a run trying to get all the way back up. Can't make it back up. But it comes down to 1, hesitates for a while, right here around midnight, moves on down, almost able to hit the 2 deviation level, isn't able to do that till early in the market open right here, and then pulls on back, hesitates at 1, does a pull back to 0.5, right around its close. And we can go in, let's look at the Dow. So on the Dow, flat just like the S&P. We got the NASDAQ. And flat as well. So there's not a whole lot happening. Had a cool trade this morning if y'all were watching. Tommy went in, he talked about targeting the 33.74, I believe it was, and as the definite strike to go after. And so we went in as that being the target price. He went short some spreads. I went short some binaries. We took the profit off on those. Put a couple a little bit lower just in case they could potentially profit. Looks like those may expire out of the money, but what the cool thing was, we brought in more than enough on those other trades that we were just using part of the profits to put on those, high profitability, low probability trades that were further out. So we had a definite strike, and then this would be sweet if it hit this strike. And I'm using the first one to bring in some profit and use some of that profit for a potential high payout on a lower price. But go back, check out that show this morning. It was a perfect call. Worked out really well. And let's see, you got the Russell. And it's looking about the same. It's been a little bit more on the negative side of things, just briefly above settlement early this morning. Okay, so what do we got coming up before we wrap up for Friday? What do we got coming up this weekend that you need to be aware of? Daylight savings time shift is happening over in Europe, Britain, Switzerland, all that. So that will change some of the times of the reports. That'll change the times the Forex markets move because those traders are getting up. So just be aware that daylight savings time shift is in effect. On Sunday, New Zealand is going to be having a holiday as well. Not a big deal for most traders out there. We're not trading on Sunday anyway. But they're moving their clock back an hour. Okay? So again, so UK, EU, all that, again, backward by an hour. So if you are used to the markets moving at 3 a.m., they're going to start moving at 2 a.m. Okay? And that can also bump up some other things in the market. And on Monday, we got pending home sales. So should not be a major market mover in and of itself, but do keep an eye on that at 10 a.m. That's your one report you need to be watching if you're trading, just because if it does come in way off, it can cause a little volatility there. All right, y'all have a great weekend. I'll see you next week.
What's the one thing that pulls people back from the breakthrough that they're moving towards? What's the only thing that really stops people from taking action? You and I both know the answer, and sure, we can come up with the reasons why we're not where we want to be, but the only reason that we don't do more with our life is fear. Or if you're an overachiever, call it stress. Simply put, there's something that happened to us in our past that's holding us back from the life we deserve, yet you and I are okay, we're here. So why should we let our past control our future? Exactly. We shouldn't. Hi, I'm Steve Rhodes with TFNN.com, and when it comes to your trading and investing, I can help you overcome your fear of loss. Together, we'll turn weakness into strength with a system I've developed called Mastering Probability. I'll teach you how to make your money work harder for you than you do for it. I'll teach you the tools that provide financial freedom. Go to the homepage of TFNN.com, click on my name, Steve Rhodes, and begin your journey of mastering probability risk-free. It's time to become a pioneer of your future versus a prisoner of your past.